Good evening, ladies and gentlemen. Welcome to the next in the round of NCAER's webinars. This one specifically focusing on the macroeconomy, and we are presenting our quarterly review of the economy for the second quarter of 2021. I'm delighted to be hosting the QRE team, the Quarterly Review of the Economy team, led by Sudipto Mandal, Distinguished Fellow at NCAER, Dr. Bonali Bhandari, Senior Fellow with us, and Rudrani, who is with NIPFP, and Rudrani Bhattacharya is an Assistant Professor at NIPFP, but we almost think of her as part of NCAER. We have two distinguished guests, Professor Ashima Goyal at IGIDR, the Indira Gandhi Institute of Development Research in Mumbai, and also a part-time member of the Prime Minister's Economic Advisory Council. And we have Pranjul Bhandari, Chief Economist of HSBC. What's of course delightful about this is the gender balance, which I think is just right. And I'm very glad that NCR hosts these events in this way. The program for the day or the evening is for the QRE team to present their work. It's a challenging time. There are many questions about what is likely to happen, not just or is happening in this quarter, but then in the next quarter thereafter for this financial year and further ahead. And these difficult questions will be taken up by the QRE team, and we will see what they have to say in this regard. We have a very large set of participants. I welcome you all to this webinar. Thank you for joining us. We really appreciate your being with us. Please use the Q&A box at the bottom of your screen to write in your questions, and we will try to leave time at the end, perhaps as much as half an hour if we can, so that we are able to pick and choose and answer as many questions as we can. And we'll try to open it up for conversation between the panelists, the QRE team, and through your questions with all of you. So without further ado, let me call upon our QRE team to present their work, and thereafter request Ashima and Pranjul to come in with their comments. So over to you, Sudipto.
Thank you. I'm going to start sharing my screen. Okay, here we are. Let me also join Shekhar in welcoming all the participants and attendees to our quarterly economic review for the second quarter of this year. I want to say at the outset that though there will be only two of us making this presentation, namely Bornali and myself, we do have a very large team that has worked on the QRE report, and their names are there in front of you on the screen. I particularly want to mention Professor Rudrani Bhattacharya. Shekhar already introduced her. Somebody who is part of our core team but is not presenting this time is Professor Bhanumurthy, who is now the Vice Chancellor of the Bangalore Ambedkar School of Economics, but I think he is joining us as an attendee, and so I welcome all of you. This is a brief outline. I will start off by giving the context and the background in which we are.
Would you turn on your full view, full screen? If you go to the view button at the top, then you, and you press full screen or full screen or whatever it is that Apple gives you.
Is that better?
I think it will still be better if you go to view at the top.
I am not seeing that screen, Shekhar.
Oh. No, this won't help. You just zoomed in. That won't help. If you go, you can't see at your top Acrobat Reader view at the top.
No, I'm not. Acrobat Reader, I have view, yes.
Yeah, press that. Yeah, now you say it's, let's see, there's no full screen.
No.
There it is, full screen mode. Go down.
Okay,
Go
yes.
down, keep going.
Yep.
That's it. There you go. Thank you.
Good. Is that better?
Much better.
Okay. So, as I said, I'll just take everyone through the broad background and what we are looking at, not just our outlook during this and the next 2 quarters, but also the year as a whole, the next couple of years, and the medium to long-term outlook. Bornali will come back and give us a more granular view of what is going on in the individual sectors of the domestic economy, the external sector, and the inflation trends. And I'll come back again at the end with some remarks on the fiscal and monetary policy front. So this is the context in which we are operating today. You see there a brief exposure to what's going on in terms of the daily deaths. We are in a very unfortunate situation where more than 1,000 people are dying every day of this virus. It's roughly about growing, and the total deaths are growing at about 1% a day. And the daily deaths are now exceeded 90,000. So it's a very grim situation. As you can see, the curve that you see there of deaths is not growing at a very high exponential rate. In fact, the rate is just about 1%, but it is growing, and it means, as I said, more than 1,000 people dying every day. Coming to the economy, as we all know, even though there was already a slowdown happening prior to this year, then after the lockdown was introduced at the end of March, we got a very sharp dip. We had been anticipating, I think, in our first QRE on the 17th of May, we had said that we would expect output to fall, Q1 output, by about 26%. As it turned out, it fell by close to 24%. And that's where we were at the end of June. Since then, we track a lot of leading indicators, and they are showing some recovery. Actually, not some, it's quite a strong recovery. So from minus 23.9% in Q1, we expect minus 12.7%. In Q2, minus 8.6%, in Q4, and then minus 6%. This is year-on-year comparison, the corresponding period of the previous year. So this is actually, when you swing from a minus 24% to a minus 6%, that is actually a fairly strong recovery, and that's the so-called V that people often refer to. That's happening right now. But with all that, we are still, according to us, going to end the year with almost 13% negative growth compared to where we were in 1920. This year, we are going to end up with a GDP output of, strictly speaking, 12.6% less than that. I have to say that this is a forecast based on a model that we have developed. I'm not going to go into technicalities now, but if somebody's interested, we can talk about the model. Now, so if this is where we are today, 12 or going to be at the end of this year, 2021, 12.6%, what is the outlook going forward? And this is where we've done some long-term simulations of alternative growth paths. Path 1 simply projects where we would have been if the pandemic had never hit us. We were growing at a trend rate about 5.8% earlier. And if we continue to grow at that path, and that is what path 1 is showing you. What path 2 is showing you is there is the dip from 1920 to 21. And then if you grow at a fairly optimistic rate, it's an assumed rate of 7%. Now, from a minus 12.6%, as I said, that's what we expect at the end of this year, to be growing at 7% plus next year, is a 20% swing in growth. So this is actually a very optimistic path. But even on that optimistic assumption, we are only going to reach the output level, roughly about 15 trillion that we had at the end of 2019-20, at the sometime during 22-23. We will only catch up with that peak output level then, and that's that vertical dashed line that you see. And then if we continue on that very optimistic growth path, we will still only catch up with the no shock path that we were on prior to the pandemic, only 20 years later, around the year 2037, 38. And this is what we talk about, the hysteresis, the long-term, medium to long-term effects of a big shock like that. It's not something that goes away in a couple of days through this thing about V-shaped recovery, and actually obfuscate a lot of the long-term effects of these types of shocks. Our assessment that is that actually in reality what will happen is we will not be able to grow at 7%. Maybe we'll be lucky if we have maintained a long-term, go back to the long-term growth rate of about 5.8%, and that is the path 3 that is being shown there. So this is the context, the background I wanted to give you, and now I'd like to hand the presentation over to Bornali, who will take us through the real sectors and so on. I'm going to stop screen sharing. So I don't know how to do that. Shekhar, I need your help.
Tell me what?
No, I'm not able to stop the screen sharing. If Bornali would start, then that would be good.
You just go to the option at the top of your screen, says stop sharing.
Yeah, it's not.
Maybe if you
okay,
just press escape.
Yeah, I think I press escape.
Thank you. Now you can see the.
What could we do without you, Shekhar?
Thank you very much. Yes, please now stop sharing your screen.
Okay, thank you.
There you go. All right, Bornali, please.
Good evening, everybody, and thank you for joining us today. Thank you, Dr. Mandal. So I'm going to focus on the real sector and the 3 major sectors in the Indian economy: agriculture, industry, and services. And before we start, just a very broad on the focus on the GDP growth. As Dr. Mandal earlier mentioned, we had in May a forecast that we would around see a 26% fall year-on-year on GDP in the first quarter, and as official estimates have confirmed, we about a 24% fall in GDP. Not only that, what we see is that since quarter 3, 17-18, GDP had been slowing down, and when we look at annual data, GDP had been slowing down since 16-17. So the main point is that the Indian economy was already in a slowdown, which the coronavirus has accelerated that slowdown. When we look at in the short run, when we look at the agriculture sector, the first sector that we turn to, here it's a very interesting story that's coming. I think the first is if you just look at overall India, and all over India here, and you can see that these are the various lines which are showing you the deviations of rainfall from actual to from normal for all the months. And what we find is that overall by the end 23rd September, we are going to end up with 8% deviation from normal on the excess. So which means that we are going to have a normal rainfall overall for India this time. However, what we find is that there have been some regional variations, and within a region also there have been variations over time. So for example, when you look at the southern region right here, what we find is that there has been excess rainfall overall till June to 23rd September. In contrast, when we look at the northern region, what we find is that we had good rainfall in June, but then over time there has been deficit, and we end up with a deficit in the northern region. But overall, given that the rainfall has been normal, this augurs well for the agriculture sector in terms of agriculture sector output, both for the Kharif and Rabi crops. Then when we go to industry, again, what we find here is that GVA, gross value added of industry, fell by 38.1% in the first quarter. What also we find, the second thing I want to point out here is here, this is very small, but what we find is that GVA industry, or gross value added of industry, was already contracting for last 2 quarters. So this is the third successive quarter. The first quarter of 2021 is the third successive quarter of contraction for GVA. And when we look at annual data, we also see that the GVA industry had been slowing down since 15-16. When we look at the leading indicator for in industry, this is the Index of Industrial Production, IIP. What we find here is that the Index of Industrial Production actually very sharply contracted in April. But the first is that you see the V-shape sort of recovery, where from April the Index of Industrial Production has recovered since April. However, this is the year-on-year change. So when we compare the July 2020 data with July 1919 data, what we find is that it still is contracting. So while the industrial growth has moderated since April, what we find is that overall it still is contracting on a year-on-year basis. The second thing, another very important point, although not shown in the graph, is the PMI, the Purchasers Managers Index, the Nikkei Purchasers Managers Index, which is another leading indicator, and it returned positive in August. Rather, not positive. It was a number. We got a number above 50 in August, which indicates expansion in the manufacturing sector. Again, it confirms, overall it confirms that we are recovering in the short run. When we look at the third sector, the services sector, again, it is a similar story, that the first quarter it saw a very sharp decline of 20.6% in the first quarter. However, when we look at the quarterly trends and even at the annual trends, we see mixed growth trends. The stories are not, there's no fixed trend across. The leading indicators from the second quarter are that all of the indicators are not shown here, but when we look at various indicators from the services sector, what we find is that they sharply declined in April, and then from April onwards, we see that the service indicators, we see a sort of recovery from April, where the contraction rates have moderated, but they still continue to be negative, contracting on a year-on-year basis. Specifically, when we are looking at the picture on the left-hand side of the panel, we are showing the transport sector, both passenger and cargo traffic. The left-hand panel is showing you the cargo traffic across various modes, roads, railways, and airports. And here is the similar story, is a sharp decline across modes, and then a recovery, but they continue to be negative. The blue line is showing you the railway traffic, cargo traffic, the revenue earning goods traffic. And here the number, the growth rate on a year-on-year basis is actually positive, which is again a positive signal coming out in August. In contrast, when you look at the passenger traffic, this is the air passenger and railway passenger traffic. What we find is here also we see some recovery since April, but it's much, the recovery is very slow or very marginal, especially compared to the cargo traffic. So, and the PMI services till August still continues to be below 50, which indicates contraction. the overall, for all the three for industry and services sectors, we see that we are going to improve some from April onwards. But we have seen some recovery from April, but on a year-on-year basis, they still indicate contraction. When we look at this was a domestic sector. When we look at the external sector, here the story is that again we see a very sharp decline in exports. We saw a very sharp decline in exports and imports in April, and then again a recovery in the July and August, specifically over time in the last 4 or 5 months. But the important thing is, if you see the difference between the red line and the blue line, the red line is the exports of goods and services, and blue line is the imports. And what we see here is that exports has shown a faster recovery rate than imports of goods and services, which translates to that the current account surplus, that means the trade, not current account, the trade balance of goods and services combined has turned into a surplus both in Q1 and also in July and August. So, I mean, this is something of a first that we have seen for many years. Another very key development that has happened over time, over the last couple of months, is that our foreign currency assets have shown a very sharp increase. Especially, you can see in July and August, they've shown a very sharp increase here. The blue lines are the foreign currency assets. And not surprisingly, what we see is the exchange rate, the rupees per dollar exchange rate, has actually been appreciating. So after a very sharp depreciation in April, over time, as the foreign currency reserves have gone up, assets have gone up, the exchange rate has actually appreciated. On the right-hand side panel, what you see is both the exchange rates, both nominal and the real effective exchange rates, which is nominal is the US per dollar and the real is the one that RBI computes. And what we find here is that again, after a very sharp depreciation in March, what we find is a slow appreciation of this currency. Now, what does that imply for us? What it implies is the appreciation of the currency means that it will arrest any imported inflation, but it may have a detrimental impact on external investments. So, so it has both positive and negative sides to the appreciating currency. Overall, when we look at inflation, and this shows you the CPI headline inflation, retail inflation over time. This is using quarterly data, and the red line is showing you what we have, and the blue line is showing you the forecast. What we see is that inflation has actually, in Q1, it was at 6.2% in the first quarter. And even in the second quarter, in July and August, we see that inflation is going to stay at, was at 6.7% in both the months. And it's so Q2, we forecast that inflation is going to stay at 6.6. And then in Q3 and 4, they're going to stay around 6.4%. So for the whole year, both actual and forecast indicate that the inflation is going to stay above or outside the 2 to 6% inflation target band of the Reserve Bank of India. So that's the second challenge. That's another challenge that we have along with the negative growth. So this would make the monetary management extremely challenging. On that note, I stop again and pass on the baton to Dr. Mandal, who will now talk about policy. Dr. Mandal.
Hi, Bonali.
Yes.
Rudrani, are we going to come in as well, or you're not going to say? I know that Sudipta said you're not going to. You muted. Sorry, Rudrani. As an active partner, I'd love you to also say at least something about, especially since you're handling the high frequency work.
Yeah, so I have actually done those growth forecast and the inflation forecast. So the implication of those is already Sarah and Bornali has told. So if anybody is interested about that, what is our, how we have come up to those numbers and all, then I'll be contributing to that.
Okay, thank you very much, Rudrani. We are doing very well on time. Thank you, Shudipto and Bernali, for doing that. What I'm going to do is request now Ashima Goel, Professor Ashima Goel, to provide her comments.
Shekhar, we have not finished our presentation.
I'm sorry, I thought you had.
No, I just handle a little bit, few slides on the fiscal and monetary policy, if I may.
Please, 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 please. Sorry.
Sorry, Ashima. Sorry to keep you waiting a little while longer.
Not at all, Shudipto. You said you were going to come back, so I was...
Yeah. So I'm sharing my screen again to talk a little bit about the fiscal and monetary policy aspects. I want to start by saying that, you know, we have...
we can't see your screen as yet, Shudipto.
Okay.
Please do share.
Can you see my screen?
Not yet.
Okay. Oh. Okay, sorry. Can you see it now?
Yes, we can. You just go to the full screen, enter full screen, yeah.
Acquiring new technical skills in presentations. Zoom presentation. Okay, so I wanted to point out that we have had a pretty poor record in our fiscal marksmanship, but it has gone particularly off track in recent years. And you see the kind of budget projections we're doing. In the budget estimate for 1920, it had been estimated revenue would grow by something like 18.3% compared to the previous year, 1819. What in fact happened was the exact opposite, that revenue, this is tax revenue, actually shrank by 18.3%. So one would have imagined that that would be factored into the budget made in the subsequent year, namely the current year, 1920-21. Unfortunately, the tax revenue projections become even more ambitious, saying that tax revenue would grow at 20.6%. Now, this is, of course, before the coronavirus pandemic and the lockdown hit us. What has happened since then, you are now seeing on the screen, and we have now compared the tax revenue for the period April-July, for which we have the data. You can see that the lockdown has led to a very sharp contraction in economic variables that got translated into a decline in tax revenue. Overall tax revenue has declined by nearly 30%, and there's a little bit of breakdown there showing that direct taxes have declined the most by 33% and indirect taxes by 27%. But within indirect taxes, the largest component, central GST, and this would be the same of state GST. Central GST accounts more than about 50% of central tax revenue now. That has also gone down by 34%. So very, very sharp slide in revenues. Now, the fortunate thing is that this has actually not been passed on. It could have been passed on as a similar contraction in expenditure, but the government has not, the central government not contracted expenditure, while overall revenue declined by 42%. And now I'm not talking about tax revenue, but tax plus non-tax revenue, and that decline was about 42%. Expenditure during this period, April-July, has in fact grown by over 11%, which is pretty much in line with what the budget had said. I think the budget had said, 12 or 13% growth. actual growth has been about 11.3% at a time when everything else has got contracted or compressed. So that is quite significant. Now, the way this has been done is that the revenue shortfall has actually been compensated by an increase in borrowing. And there you can see the last pair of columns there. The deficit up to July has actually gone up by about 50%. So it's increase in borrowing which has absorbed the decline in revenue receipts, so that expenditure has not really been compressed. And I want to say in this context that if you all recall, a few months ago, there was a lot of discussion about how the government was not really doing anything significant. There was token provision in the Atmanirbhar Bharat program and so on. And that has continued. I think one of the reasons behind this is that about the way that program was presented as the government's, 10% of GDP stimulus program and so on. But then when people examined it, they found that really only at that time about 1.3% of the GDP actually consider fiscal components. That element has gone up. It's about 2.4% now. They've been adding some components. But it is still a relatively small part of the total stimulus the government has provided. Just to look at it, looking at the table now, the central government budget deficit that's in the budget was 3.5%. After the budget, there was additional post-budget borrowing of 2.1% because they could see already that the revenues were going to shrink. Then there's that 2.4% added on under the Atmanirbhar Bharat program. And then you have to add to this the deficit of the state governments, which is about 2.8% of GDP. Additional headroom has been provided for them to borrow this year, but that additional headroom came with some stiff competitions about power sector reform and so on, so I'm not certain that it will be done. Anyway, that if that were to be done, it would come to nearly 13% of GDP. And if it is not done, there will be other elements. For instance, at present under this new, the GST compensation scheme discussion that's going on, it's most likely that the next GST Council meeting, they will allow that extra 5.5% headroom, because most states are actually wanting to take up the proposals of the central government on how to make up for the shortfall in the compensation cess. Also, there may be in a busy season borrowing program, which will be announced fairly soon around Diwali. There may be even further additional central borrowing and so on. So I think an assessment that about 13% of GDP is going to be the combined fiscal deficit of the center plus states is quite realistic. But you have to add to this also the off-budget borrowing of the public sector enterprises and so on. It's about 1% or so for the central government, but also state governments also undertake this kind of off-budget borrowing. So our assessment is that probably something like 14 to 15% of GDP is the actual public sector borrowing requirement. Now that is in fact a very large stimulus. When you add to that, a substantial liquidity infusion on the monetary policy side, I think you're looking at something like 15% of GDP in terms of the total stimulus. Now, there is a view that this is not what we should be looking at. We should only looking at the fiscal impulse. That is not the total deficit, not the total stimulus, but the change in the stimulus compared to last year, because we are, of course, looking at rates of growth. There can be some discussion in that, but let me finish that by saying that even if you look at the fiscal impulse, that still amounts to a very substantial 6.5% of GDP. So that's what has to be funded out of our financial sector. And that brings me to the very challenging task of the monetary policy authorities. On the one hand, you have you have this competing policy goals that on the one hand, you have this huge dip in economic activity. You want to revive that. On the other hand, you have a headline inflation that now exceeds the RBI's target band of between 2 to 6%. It is around 6.7% now. So there's the completing policy objectives here. Now, given this context and that liquidity infusion has already been provided by the RBI and the substantial fiscal stimulus I talked about, that is really has been the policy position so far. On the repo rate side, the RBI reduced the repo rate as part of the expansion program from 5.2% in February in a few steps down to about 4% in May. Since then, because of elevated inflation, there has been a pause. And there's a new monetary policy, interest rate policy statement coming up fairly soon, and we shall see what the RBI decides to do. I should mention here that in our view, the RBI should stick to prioritizing what is to be done to revive economic activity rather than worrying too much about inflation, mainly because it is now well known, there's a consensus that much of the inflation is cost push inflation being driven by supply disruption that have happened during the economic lockdown and so on. And as that gradually improves, then you'll get a better supply response coming. And that really is what will cool down the inflation. It is not really a monetary policy demand management task. Other aspects of monetary policy, there used to be a very frustrating situation where the RBI would reduce the repo rate, but it would not get translated into a reduction in bank lending rates and so on. That situation has improved quite a bit. And as you can see there in this chart, the scheduled commercial banks as a whole, their average lending rate on new loans has actually come down by almost a percentage. And when you look at private sector banks, it's come down by more than 1%. It's come down by even more if you look at foreign banks. The segment that is lagging behind the public sector banks, where it has declined only 0.7%, that's why the total reduction of average lending rates on new loans is not as much as the reduction of the repo rate. Transmission has also happened not just in bank lending rates, but also on the yields on government securities. You will see there that the short maturity securities have very closely tracked the change in the policy of the repo rate, which is the dark black line there. And close to it, tracking it, is the 91-day Treasury bill and the 364-day Treasury bill. What has not been brought down yet successfully is the yield on the benchmark 10-year government securities. And the RBI has actually been struggling very hard to try and get that down. Even this morning, we found that they have been taking some special measures for this, but so far that's work still being done. A bad aspect, not very successful aspect, is what's happened to credit flow meanwhile. Credit flow actually has declined further in 2020 and is declined in all segments, but is hurt most strongly the micro, small and medium industries sector, where it has actually become negative, the flow of credit. And this is despite the fact that under the Atmanirbhar Bharat program, there were a number of components to try and reduce risk aversion of the banks who have not been very keen to lend to small, medium enterprises, or even lend to the non-bank finance companies, which are the route through which actually most of the credit flows to these small businesses. Why has this happened? Lenders prefer to stick to low risk, low return government securities, but also, and a more challenging issue is that even on the demand side, there is a reluctance actually to borrow on the part of the entrepreneurs, businesses themselves. They're not very confident that in this present situation, they'll be able to service that debt. And our suspicion is that so long as this large government borrowing program persists, it may not be possible, despite its best efforts, for the RBI to make a very big dent in this. And now I come to my really final few remarks. The financial sector as a whole was already under great stress prior to the lockdown. As we all know, the gross non-performing assets ratio was already at a very high level of 8.5% in March. That is before the pandemic hit. Now the latest RBI's financial stability report tells us that they've conducted stress tests on over 53 commercial banks, and those indicate that in a very severe scenario, that is the situation getting worse than it is now, this could spike up to as much as nearly 15% of GDP, the gross non-performing assets. Even in a moderate stress scenario, it could be well over 12%. So this is quite a grim scenario. We feel that it's probably not avoidable to do some amount of monetization in the short term to reduce the crowding out effect of this large public sector borrowing program, which is being reflected on the elevated yields of 10-year G-Secs and so on. But to really strengthen financial stability in a medium to long-term sense and to strengthen the health of the financial sector, I think continued focus on reform in the financial sector is very important. And top of the line there would be strengthening of supervision of banks. Had that been there, we would not have been in the situation we are in today to begin with. Then probably now the establishment of a bad bank to clean up the balance sheets of the other banks so they can resume proper operations. And finally, if there's recapitalization of public sector banks, that not be done without governance reforms, in particular the reduction of equity held by the government in these banks. And even if that is reduced to just a little less than 50%, that could make a difference in the governance, and it would incidentally be a source of recapitalizing banks without financing it out of the budget. So let me stop there, and thank you very much for your attention.
Thank you, Sudipto. That's a very comprehensive overview. No wonder I was trying to skip it, given how challenging the agenda that you set out will be. But against that, I think it'll be great to hear from Ashima and Pranjul. Ashima?
Thank you, Shekhar, and thank you for the invitation. It's really nice in this time of change and uncertainty to get a guidance from an institution everybody looks towards, because there's so many market forecasts and we're all over the place. So a little more robust work. But just for the sake of debate, I'll raise a few contrarian points. So I'll start with both Bornali and Sudipto said that continuous decline. So there I would just like to point out the Bornali's chart. You had IIP in Feb was 3.8% growth in February 2020, and other high frequency indicators also. So when you look at it quarter by quarter, there's a successive decline. But in February, there was some recovery, right? So, and it's the same thing for the financial sector. We were in a really bad situation, NPAs, etc. But this was all through the last decade. But a large number of reforms have been done. And for example, under IBC, banks have recovered a lot of, made a lot of recoveries, and their provisioning is very, very high. That's why gross NPAs, I think Sudipto had this figure of 8.5 for gross NPAs, but net NPAs have fallen to 4%. Why? Because provisioning was very high, and this was covering, and they would get recoveries and that would go straight to their profit statement, etc. So the point is that things are not so bad because Now, why was there this continual slowdown? I think starting with ILFS and that whole credit tightening which we saw in the system, not only sectoral, it was also aggregate. And at the same time, we had some external shocks. The Fed raised rates, and so, but then in mid-2019, we saw some reversal of this, and NBFCs were not getting credit. The traditional macro liquidity window of last resort was not there for them, so no credit going to consumers. And we saw that I think credit growth really fell very, very steeply in 1920 H1. It was just 12% of what it was the previous year. So, and this was a period when the rest of the world was doing QE and households and firms were, their gearing was rising, credit debt was rising like anything. In India, we had a very strict tightening all through these 10 years, which partly shows why investment collapsed and IIP growth was low. So, and it was worsened, as consumers just stopped buying, as NBFC stopped lending. So what I'm saying is that the liquidity, the release of liquidity into the system led to a reversal. It was working. Then COVID came along in March and everything collapsed. So therefore, to the extent that COVID has brought about a larger infusion of liquidity, there are schemes for NBFCs that have been fine-tuned, they're actually borrowing. And even SMEs, this because risk aversion was obviously high after a lot of corporate failures and so on. But the government warranty, I believe that they've sanctioned something like 1.5 trillion rupees to SMEs now. So all these figures are changing very fast. And to that extent, we can have a credit-led recovery, because unlike the rest of the world, we were squeezing credit earlier. We can reverse that, and that can help us. So now just to talk about this this post-COVID, that V, I thought it is a very nice illustration that you can have a V-shaped recovery, but it's not much use and it's still negative. But to understand that V, we know that there's this total very, very strict lockdown in April and May. And then growth obviously collapsed. But in June, that those V curves you showed, there's a very rapid recovery in June, when the unlock started. But then after that, the infection spread and states started doing arbitrary lockdowns. So in July and August, you had a sort of plateauing, not much recovery. But September again, because the unlock 4 in September, what it says is that states are not to stop not to restrict interstate travel. And that was playing havoc with supply chains, if you talk to industrialists. So I think now there's a realization that micro-containment, physical distancing, masks, etc., can flatten the curve. It has worked in Delhi earlier, it worked in Bombay earlier, and now again it seems to be working. So what they've done is they've unlock proceeded too far. Along with COVID fatigue, there was too much of, roads were really crowded in Bombay. Then they imposed Section 144 last week. And again, you're seeing that flattening. So the point is that we can contain the infection, we have to live with it. Unfortunately, it seems more persistent than we thought it would be. But it need not disrupt supply chains so much. So just to illustrate, we know that the growth fell in India quarter on quarter 29%, but South Africa, they had a 6-month lockdown. They had a lockdown all 3 months of this quarter, this Q1, and growth there fell 51%. So we saw a recovery in June, flattening, so the growth fall is more because of the lockdown, not necessarily because of the virus. Industry can recover to some extent as long as we learn to manage that balance between lives and livelihoods. And maybe we are learning a little bit about that. Then the other thing is that I think you make a point somewhere that you need massive reforms to really have a higher rate of growth. Otherwise you might settle at a low 5% or something. I'm saying that COVID itself, one of the puzzles in India when you come to manufacturing is that why is the share of manufacturing so low? Most countries in the catch-up, it rises to 30. Look at China. Here it stayed in the mid-teens. So I think that there are a number of factors which are there anyway, and COVID has intensified it, which are a plus for Indian manufacturing. I like to say that we moved from import substitution to import competition. We opened out too much competition. These FTAs, Chinese factor, the huge current account deficit we have with China. And now we are moving towards export competition, where industry competes export. So partly because of China and the diversification of supply chains, people realize they don't want to be too dependent on China. The government itself is giving some, protection for Indian industry. Like API, we realize that relying on China for that is if China had stopped supplying, what would happen? We would not even be able to produce medicines we needed. So all that, and then the government reform programs. Now we've seen labor market reform. So linked to that, you want to attract firms, so give more flex from abroad. So you give more flexibility in labor. People have been asking for this for so long, but finally it is there. But more than the flexibility in hiring and firing, it is that the regulatory simplification. I think a lot of the government reforms are about that, reducing compliance requirements. So these labor codes are so complicated, the old labor laws, and now they're simplified. So I think, and then there's a move towards KYC, centralized compliance, where all regulators will be able to pick up from. So all this, then trust. I think the last decade, because of all the investigations following the NPAs, led to a lot of distrust between government and industry. Now government is supporting industry to some extent for a growth revival. I think it's an opportunity for healing. Similarly, in the financial sector, which can sort of give a boost to, and also to growth again also. And there are, you're seeing very rapid digitization where India has an advantage. Production of vaccines, India will have an advantage. So all this is going to help manufacturing. We're seeing some services earlier becoming products, which like in India we saw service sector growing. So like, people are not going to restaurants, they're buying more packaged food. So fast moving consumer goods have done very, very well. So there are these positive trends, I think, for Indian manufacturing. And then when we come to services, similarly, Rudrani, I had a quick look at your nowcasting model and the indicators you use. It's and it's the same thing with the estimation of GDP, which gave us this 23-24% fall. The indicators, because very poor data is available for that quarter. So the indicators available are on transport, road, rail, etc., etc. And that we know with the lockdown, there's an absolute crash. Yeah? And even after that, as infection persists, private transport, passenger traffic is not going to recover. But at the same time, people are still there and they are consuming, but they're substituting home services. And there was a push to local. For example, you could not get the big brands, so you were buying local products, local manufacturing. The government is also trying to support that. So, there were a lot of positive trends at the same time, which are not captured in the data. And to the extent that the forecasting or nowcasting depends upon available data, which underestimates. There is an argument that service sector, there's a much larger contraction. It's not captured in the data. So it could go either way. It could be an overestimation or underestimation. But I think for the services, people miss out that there's been a lot of systemic formalization. They've started registering for GST, and then there's fintech, and so modernization. Our service sector can't remain the way it was forever. And so it's part of the churn, the change in society, which is overall positive for growth and for higher potential growth after we get over this period. Then I think the exchange rate, you talk of the trilemma, but actually there's a quadrilemma. A lot of international literature talks about this. There's a lot of use of capital flow management, it's called politely, no longer capital controls, market-based, and also macroprudential regulation. So I think there are many tools the Reserve Bank has. It's not just, we need not be scared of too much appreciation. Some appreciation, all right, is anti-inflationary, etc. Because there are other tools, and now internationally, people are beginning to realize that emerging markets are at the receiving end of, again, QE and FPI volatility, which has resulted in this huge reserve accumulation. Very difficult for us to conduct macroeconomic policy. Then a little bit I will say about prices, inflation. You notice that it's been above the RBI's bounds, etc., etc. But then a lot of And in the last decade, we really suffered because of this gap between wholesale prices and consumer prices when we are targeting consumer price, and what is relevant for firms is wholesale price. So they've faced huge real interest rates and they were used to negative. But this time, I think it's going to be temporary, because if you look at food prices and WPI and CPI, it's the retail inflation, because the lockdowns and so on. So that is likely to be temporary. And then overall, because demand is soft, so core should slow. The increase was due to gold and things like that, which again, gold prices are falling now. So and then I think there are some long-term trends again, which are positive for India here. One is oil prices are likely to be low now. Apart from the global slowdown because of the movement towards green, because of shale and so on, and that is a major plus. So inflation expectations, it affects, as well as, and then food prices. I think we're moving towards structural surpluses in agriculture. The problem now is surplus, too much of production, not too little. That's why there's farmer distress. And there are a lot of agricultural reforms which should reduce that intermediary margin and keep food prices soft. And those are the ones that really create second round inflation. So I'm happy that Shadipto is not adding to the pressure on the government to spend, and is saying the government is actually spending quite a bit already. And but I think this concept of self-adjusting fiscal deficit, and also the timing of a demand stimulus, we have to be very, very careful, and the government has to be very, very careful in what it spends. Let me say that these are all my personal views, not those of the government. So, because earlier it was all supply side lockdown. So now demand, it seems clear after the supply chains have recovered in September, it's demand which is the constraint. So this is the right time for a small demand stimulus, an additional 1 to 2% of GDP, just to help revive expectations. After all, the consumer and the private investor have to spend, government can't make up for that collapse, but it can help revive sentiments and extend it. So I think I'll stop there. That's enough.
Thank you, Rima, for those very thoughtful comments. And I think perhaps balancing some of the gloom and doom that we saw from our QRE team. I'm all anxious now to hear what the markets think. And so, Pranjul, please.
Great. Thank you for having me here, and thank you for the lovely presentation by NCAER and the great comments, thoughtful comments by Dr. Goyal. Let me try and add value if I can. A couple of things. The 1Q GDP, as Dr. Mandal had said, 24% contraction, it was in line with our expectations also. And in some sense, we know it. India had one of the most stringent lockdowns, and it had one of the most stringent contractions, deepest contractions as well. But moving on to the next quarter, which is July, August, September, as a lot of your own data showed, many indicators are going up, and some of the others we track are e-way bills, electricity consumption, and one that I really like is Google Mobility, because it gives you a lot of interesting flavors. Now, what we found in Google Mobility is that it's actually shot up quite a lot in August and a little bit in September too. But when you break it down, you find that a lot of the increase is not your trips to your workplace or to the grocer, which are the more sort of sustainable trips, but rather trips for recreational reasons, which I think is induced by festive demand. Ganpati, for example, in August, and we actually saw recreational mobility really go up in Maharashtra. So I think we need to sort of keep that in mind, that many forms of increase in activity are a little bit one time. They may not be very sustainable. They are because on the back of festival. So just one thing to track alongside, we know activity is increasing, but to what extent is it sustainable, and to what extent it's a one time. Generally, what we are finding with all the data we track is this is turning out to be a two-speed recovery. For every one sector that is doing well, one other is not doing well. So one example is rural doing well, urban not doing very well, manufacturing picking up quite well, services still contracting, especially if you look at PMIs. Formal sector gaining market share, but at the cost of the informal sector. And capital markets doing very well, but the real economy not doing that well. So this is, your classic two-speed recovery at this point. One thing that is looking interesting is the role of the consumer. In the past, we've benefited a lot by the Indian consumer in recoveries. This time, I worry that consumers are not spending very much. So it's about how consumers perceive this entire problem to be. If they perceive it to be a short-run problem, then as we know, they try to smoothen out consumption by dipping into their savings. But the minute they start thinking it as a longer term, a more permanent kind of a problem, then they may actually try to lower their consumption and actually raise their savings. And I worry that we may be going from the first camp towards the second, that consumers are getting a little depressed about their salaries, about their jobs, about their wage prospects, and they may end up saving more, which I would call precautionary savings, and not consuming very much. In fact, there's some very good data we got on it recently. The RBI's Consumer Confidence Survey, which shows that more people think that they will be consuming lesser 1 year ahead than they are consuming right now. So I thought that survey did sort of give a sense of how consumers are beginning to think as this pandemic period is progressing. In terms of GDP growth, our own numbers for FY21, we have 11% contraction. And for the 4 quarters, it's actually not very different from NCAER. Of course, the first quarter was the worst, and it gets better and better. In fact, we have it getting a little better, a bit faster than you have, and almost sort of 0% growth by the 4th quarter. So we sort of go into a little bit of positive, but broadly in line with what you have. What I wanted to point out was FY22, the next fiscal year. We have a big increase. We think growth could be 8%. A lot of it will be because of a low statistical base, but I think a lot of it could also be because of pent-up services demand. In the same way, this year in May, June, and also July, when we came out of the lockdown, there was this huge amount of pent-up goods demand. Perhaps next year at some point when the pandemic is largely behind us, hopefully it will be behind us at some point, then there could be a big pent-up services demand. People taking holidays after a long time, hotels, going out to eat, restaurants. So there could be a lot of activity on the back of that. But my worry is that, almost everything that we're thinking about is one time. Pent-up goods demand is a one time. Pent-up services is a one time. Statistical base effects is a one time. Festive demand is a one time. At some point when all of this passes, then what are we left with? And we try to look into that in some detail. And our own sense is that India's potential growth had already slid from about 8% a decade ago to around 6% on the eve of the pandemic by our estimate, the work we've done. And my sense is that it could fall by about a percentage point more to about 5% post-pandemic. So that's my estimate of the economic scar that the pandemic could leave behind. Now, what could drive this 1 percentage point fall? I think there are 3 contenders. One is labor disruption. The second is logistical issues we've been facing, and the third is finance. My sense is that the labor and logistical issues will be fine. That won't be the big driver of the fall in potential growth. My own sense is that the millions of people who've gone back to rural India, many of them may come back eventually for the simple reason, because if you go into why people migrate, most of them are aspirational migrants. And urban wages are 2.5 times more than rural wages. So my sense is, once the harvesting season is over, a lot of them will come back, and that's not a constraint I think will linger on. My worry instead is the state of the health of India's banks. You already mentioned in the NCAER presentation that the non-performing loans were already quite elevated even before the pandemic. And I worry that once, this 2-year restructuring program and all of that is behind us, the non-performing loans could be much, much higher, making the banks even more risk averse. Moving on to inflation, I do think that the headline inflation will come off from where it is right now on the back of falling food inflation. As a new vegetable crop comes into the market, some of the supply side disruptions are mended, and so on. But so that is my view. So I do have it coming down from 6.7% now to around 5% in the last quarter of 2020. But having said that, there are a few risks, I don't want to ignore. And my one risk is what we call supply side disruption. Very simply, I just wanted to unpack it a little bit. What could this be? In my mind, a lot of it could be coming from India's informal sector, which did not have too much economic buffers. On the back of this prolonged lockdown, a lot of them have gone out of business. They've shut shop. We saw something similar in demonetization, and we saw formalization increase. Informal sector has high death rate. It also has high birth rate. Eventually, the informal sector came back during demonetization. But this time, I think the decimation has been a little more severe because this crisis has lasted much longer than the demonetization related disruption. And my sense is that if informal sector doesn't come back very quickly, then we may have some inflation in the interim, especially because informal sector in India is very active in the production of essential goods like food, textiles, clothing, in which the demand doesn't really fall very much. So, let's not underestimate the upside risk on core inflation and food inflation on the back of the informal sector going out of business for a prolonged period. That's sort of like my one risk I wanted to highlight on inflation. And on RBI, the challenges for the RBI have only increased. In the first half of the year, it was focused on buying this huge amount of dollars that were coming into the economy, not letting the rupee appreciate too much, and providing that domestic liquidity. Second half of the year, they have to deal with the problems of first half, but also elevated inflation and managing the fiscal financing, the large fiscal financing of the government. Here too, I think the RBI will eventually manage by striking a balance across everything, all its objectives, simply because it has a few things going for it. So one is that credit growth is weak. So a lot of the high domestic liquidity is not becoming inflationary like it normally would. Currency in circulation is high. So there's a lot of leakage from the banking system. So there is scope for RBI to buy more bonds and dollars just to replenish lost domestic liquidity. Food inflation, as I said, could fall, as a new crop comes into the market. Then a lot of the government borrowing this year, about 5 trillion, has been on the basis of issuing short-term T-bills. What the government can do is simply just roll it over. True, that will have rollover risk, but there is a market for it, and the RBI will not have to put in excess liquidity or do even more OMOs to take care of that financing. So these are a few things that are going for the RBI. I think eventually it will be able to strike a balance for now. The real problem for RBI will be once the pandemic is behind us and they want to exit loose policy without hampering growth and recovery. And finally, on reforms, I think fiscal stimulus, monetary stimulus, all of that is great. But eventually, what you need right now is continuing to do reforms. I think the big one we need is to have a sort of a wholesome package for the banks, which has everything: resolution, recapitalization, reforms. I'm a bit disappointed that the insolvency and bankruptcy code has been is being put in the cold storage for so long. I think now's the time. We actually needed it. Now's the time, because of the pandemic, some sectors are not doing well, others are doing well. We want to take out capital stuck in the ones which are not doing well and put it in the other sectors. We need a mechanism by which we reallocate capital, and that's exactly when we've put this IBC into cold storage. So I think that's a really important reform that we have to do. The other one is becoming a part of Asian supply chains. I think we really need to persevere on that. It's a once in a lifetime opportunity. Once we've lost it, it's not coming back very quickly. And finally, my favorite one, which doesn't cost anything but has huge gains, is just an environment of policy certainty. Having sort of a stable tax regime, stable FDI regime, rules-based policy making. I think that also can do wonders for medium-term growth. So I think I've already spoken a lot, so I'll end it there.
Thank you, Pranjal. That was very useful, and I much appreciated the actual details to which you went, both in terms of the current situation, but also the impact on potential growth, which I think is really very, very important. This has been very interesting, and we've taken a bit more time than we thought we would. But let me turn to Ashima and ask, Ashima, there are a number of questions that have come to you. Would you like me to just look at them and read them out? There's one from Suman Berry, which I think has been answered already. Okay, so people have been very good. The panel has been very good and has been answering questions. That's great. Ashima, there are a couple of other questions, but before that, let me now then turn to Sudipto. Sudipto, any thoughts on the comments you had from Ashima in particular, which did challenge a few of your conclusions, and that's very helpful. That's exactly the role of such a discussion. Yeah. But Sudipto, would you want to take a turn at that?
Though Ashima said she was taking a contrarian view, actually I think we are on the same page on many things that she raised, maybe differences of emphasis or nuancing. For instance, I'm glad she mentioned it. I think a lot has in fact been done on financial sector reform, especially of course the IBC. What we would like to see is more progress on that, as Pranjul was just mentioning. The other thing on which I completely agree with her is that what we are seeing now is really the impact of the lockdown. Of course, things were slowing down even earlier because she going on referring to what the situation was in February and the big shock. And that, of course, we all agree that we would not have been in this grim situation today if we didn't have that lockdown. Also, I agree with her that quite a lot of reform initiatives have been taken or are being taken, and others have also mentioned this. A couple of remarks, for instance, on trade. In fact, trade reform that were brought in 1991, the tariff reforms, and we have gone back on that in the last 2 or 3 years. And that, I think, is a very serious reversal of reforms. On some of the things being done now, of course, many of us have argued for years about the importance of, removing this monopolistic power of these agricultural marketing cooperatives and so on, which are actually dominated by traders, not by farmers. But, there's an aspect of this, whether it's farm reform or labor reform and so on, land reform, about center-state relations. And we need to keep that in mind because we do have a constitution which assigns some subjects to the center, some other subjects to the states, and some are, concurrent list and so on. So I think an issue that needs to be addressed is really, are these reforms to be done by the center or the states? But apart from that, as I said, I think it's matters of emphasis and nuances, but basically we are very much on the same page. And what Pranjul was saying, I think I almost wholly agree with what she said. I think we are looking at a long-term growth path, which is potentially growth path is small, maybe 1% higher than what she was talking about. Though the short term, this year's shortfall, we are a little more pessimistic in there, but broadly we are more or less on the same page. So not really contrarian views. Let me stop there.
Thank you, Sudipto. Pranjul, there's a question for you from Beena Agarwal about pessimism, your pessimism about the informal sector's recovery. And she's contrasting that with agriculture having done fairly well recently. And how do you put the two together? Pranjul?
Yeah, so look, I do agree with her that, in fact, I said it at one point that it's a two-speed recovery and rural is doing well. And there are a bunch of reasons why rural is doing well. One is the rains. The second is a lot of the NREGA spending, PM Kisan, has gone to rural India. Third, there's a lot of labor and a lot of people doing a lot of work, and we're seeing record sowing levels. So things have been good for rural India. My worry is that if you track wage data, rural wages haven't risen. because even if production has increased, the number of people who are taking from this production has also increased. So, so we're not really seeing rural wages rise. And I think eventually once, this whole harvest season is gone, then at some point rural India will have to grapple with some of the structural problem it has been facing even before the pandemic. And one of them, for instance, is that more and more they have been, more and more rural workers have been working in construction, and construction is a very weak sector right now. A lot of the rural landed have been facing a rise in indebtedness, and that really hurts when nominal GDP growth falls so much. So I think some of the structural problems will come back to bite. And I think that's one of the reasons why I also think that at some point, all of the reverse migration that we've seen, a lot of these laborers will want to come back to their urban jobs.
Thank you, Pranjal. Ashima, would you want to comment on some of the concerns about the financial sector that Pranjal,
Sure.
I think, very rightly pointed out, and it's on many people's minds, and I'm sure it's on yours. How do you see that from your perspective?
Yeah, I think also because Pranjal pointed this as an area she's very worried about, and most people have this perspective that India's financial sector is in a very bad state, and that creates a lot of risks. And again, I think that's reasoning backwards, sort of seeing the problems in the last decade, and that nothing has been done about it, and it continues, which is not correct. A lot has been done, because there was a question about IBC also, and the suspension. Now, I'm on a bank board, and one reason I joined is really to sort of see what's happening inside bank with the largest NPAs, with NBFC also. So you get to know the inside story, and I can see, they're telling me that the suspension doesn't matter because anyway there were large delays in IBC. It wasn't keeping to its timelines. But it's really improved credit culture, because they are able to tell their borrowers that if you don't pay up or settle or whatever, then we will take you to IBC, and it ends in liquidation, whereas they lose their assets. Earlier promoters used to never repay loans and just pocket them and strip the industry, and that sort of thing has really changed. I'd like to point to another figure from Sudipto's figures. Where he was saying the transmissions lowest in public sector banks, 0.7. Private banks, actually it's higher. Now, what is the reason? That their way of lending has changed. People keep saying public sector banks are a big drain, etc., and taxpayers' money. But see, they financed infrastructure, which we shut the development banks. There was no other way of financing it. $1 trillion infrastructure, Monte had targets and so on. So, and there's asset liability mismatch there. They were set up to sort of become, after the global financial crisis. Now they have adopted risk-based lending. They're lending very, very carefully. They are making sure they make profit because they have to make provisions, so they can't just kick the can down the road. So these restructuring, people need not worry about it, because again, it's being structured so that it goes to accounts that were not special mention accounts. That means they were robust before COVID. And in fact, these people in the bank are telling me that although everybody's hoarding liquidity, so a lot of people opted for moratorium, they actually have enough money in their accounts to pay. And if things revive, and I was telling at a meeting at CII also that why they're saying we are not paying our, the firms, our suppliers and so on, because we are worried what will happen. I said, there's so much liquidity now. Why are you worried? You'll get loans. You should, pay. And so as long as there's some recovery, and we are seeing that in this revival, I think now demand is lagging, and that the festive, perhaps the government will give a push, but I don't think firms are going to be in so much, there is permanent damage if firms are destroyed. But if they're being helped, because it's very targeted, tourism, hotel, those are being helped to restructure and survive using the financial sector. Financial sector is ready to help. Again, people say that you're piling on banks and their bad loans and their old history. But it's different now, because the advantage of using the financial sector is that the government does not have to borrow up front. And earlier there was a delay in recapitalization because you were waiting for the IBC. Otherwise all the money would go into promoters' pockets. Now it's no longer the case. So recapitalization will be upfront. I think the government has already announced. and private banks have raised a lot of equity. So they are ready to lend, they are okay, in good health. There's no reason to worry about the Indian financial sector, and it will play a large role in helping firms survive this crisis without it generating huge NPAs and problems for the financial sector. Now for Sudipta, I just wanted to make one point about the trade reform, that there's backtracking on it. I think, as I was saying in the beginning, we moved from import substitution to import competition. There was too much competition for our firms, especially from East Asia and from China. Because China actually uses unfair trade. The government subsidizes in huge ways. It's very non-transparent. We have a huge current account deficit with them. And too much dependence in pharmaceuticals, etc. So it is export promote. We are moving to export promotion. Industry has to compete and export as part of supply chains. But you are helping build up a certain economy of scale here through some targeted and temporary help. And I think that is sort of coming in the middle between these two extremes, and that will actually allow manufacturing to grow. And it's remained very low in our catch-up path. Yeah. So otherwise, I agree with Subrata that I was just being controversial and saying we have disagreements and not there that much. I remember on the TAC we used to have very similar views. And I think the RBI is going to manage the government borrowing because precautionary savings, I agree with Pranjal, huge excess liquidity. So borrowing, and since inflation, for whatever reasons, I think it's not going to be a serious threat. So some degree of monetization, although if required, only at a much later stage. Otherwise, just borrowing. Yeah.
Thank you, Shima. We have a few more minutes, and we'll maybe, with the permission of our participants and our panelists, we'll probably take a few more minutes beyond that, 3 to 5 minutes. So a question to Pranjal, which I think will probably be on the minds of many people, and it is a serious question. Question reads, I agree with the merits of having policy certainty, but how do we manage policy certainty in a rapidly evolving and uncertain socioeconomic situation, probably never seen before? So this is a supply-demand question. How do you get the supply when you need the demand the most? Pranjal?
Yeah, actually, I would like to give a very specific answer to this. I think one way to have an environment of policy certainty is to have rules-based policy making. So, it's clear on what sort of benchmarks the government is working, and then even the private sector feels comfortable that, they know what's going to happen. And one such rule that we have is inflation targeting. I want to particularly bring that up here because early next year, it's in for a review. And I think this is a time when we should double down and protect it as much as we can, because I think it has given us a lot of benefits in the past. A lot of people think about it as curtailing the power of the central bank, but honestly, the central bank the last couple of months has been able to ease policy so much, and really inflation targeting has not come in the way. In fact, it's because the way inflation targeting has been engineered. It's a flexible inflation targeting. There's a range 2 to 6%. If you miss that range, you can write to the parliament explaining why it happened, give a context. So there is a lot of flexibility built in. And I think in periods like now, when fiscal deficit is high, public debt is very high, there is a lot of gains to be had from rules-based policy making, having a nominal anchor for monetary policy, for inflation, and so on. So I think there are many ways in which, even in a changing environment, you can still give some clarity. And I think that is a real test. If you can come out giving clarity in a changing environment, it sort of means that you've really become a sophisticated economy. And I think it gives the private sector a lot of confidence to invest in that economy.
If I can just add a small bit here, because I was just interacting with some industrialists, and they are really, they're not sure what the government is something going to change. Is it, for example, the trade policies, etc. So, but I think that this government is trying to give clear signals that they are moving to improve the environment, to lower cost for business, to reduce regulatory burdens. But they are moving away from, but you want corporate governance, full disclosure, the modern system, moving away from individual lobbying, etc., corruption. So I think industry should take that picture that there are many opportunities, the road is being cleared, costs are being lowered, they have to go ahead and invest. because there's a lot of potential in India in the future, and the obstacles are being cleared. Thank you.
I hope the captains of Indian banking are listening to you, Ashima. I have a clear view from industry from Shantanu Sen Gupta at Reliance, who agrees with Pranjul on the banking sector's difficulties, and he's actually posing a question to you, Ashima. Can we see a credit-led recovery when risk aversion in the system is so pervasive? I know you were trying to talk up or talk down the risk aversion just now, but it'd be interesting for us to hear what you think about, and you know, Shantanu, clearly, since he's in the treasury of Reliance, he kind of sees this on a day-to-day basis. So.
Right, so that is why the government credit warranty was really required. Banks are risk averse, a series of corporate failures. But my view is that happened because liquidity was too tight, partly. And you've reversed that. But people are, you know, once bitten, twice shy, and the recent past huge waves. There is that baggage. But people have to have the confidence that things can be very different now because liquidity, that tightening has been reversed. And COVID has helped in that, but COVID has created its own problems. People are worried about restructuring failures, further pressures. But I think the view is that the aim is not to help firms so that they do not fail. And we are seeing that the recovery is possible even with COVID, even though it is persisting longer than we thought because the supply chain bottlenecks are being removed. So I don't think there is such a large threat of future corporate failures. We're seeing this in a revival in the corporate bond markets and the reduction in the spreads. So there is some reduction in risk aversion, though there is still a long way to go. And you know, but it's like industry that keeps worrying and refuses to see opportunities will lose a profit opportunity.
Thank you, Ashima. I'll end with just two questions. I don't know who they are addressed to, but both of them are important. One, of course, is going to the new legislation that has just been passed on agriculture. And particularly Sanjeev Pohit from NCR is asking about the APMC Act, with Bihar having repealed it in 2006, but not really seen any great surge in investment in the agricultural sector. I think that's a serious question. And then there's a second question from, again, from Beena Agarwal about things that haven't been said, and they typically aren't said or talked about a lot in these kinds of macro discussions, but they are important nonetheless, on unemployment and rising inequality, and how society is going to be affected by this dip in growth and clearly the loss of jobs that we have seen so dramatically in the last few months. Sudipta, do you want to pick up on these as the prime leader of the QRE team? You'll have to unmute yourself.
Yeah, sure. You know, Sanjeev has raised a very interesting comment. In fact, the fact that Bihar had removed its APMC already earlier gives us almost a laboratory experiment situation, which you rarely get, of what will in fact happen. And I was only made aware of the Bihar case fairly recently, so I haven't looked at it, but we should examine this carefully. One is a question of drawing investments and so on, but a more immediate question in my mind is what has it done to the kind of prices that farmers have realized? Say farmers in UP, not for wheat and rice, those have procurement prices, but for vegetables and potatoes and onions and things like that. Are they better off or worse off in Bihar compared to neighboring states? Is a question I think is very important. I would like to know what has happened. I don't have the answer. On the very important question of unemployment and inequality, we have to make observations based on information that we have. On inequality, there's not much that I can say right now, though in principle I agree with what Beena is saying, that digitization, it may have reduced access inequality and so on at the upper reaches, but lower reaches it may have got worse. We just don't have the information on that. On unemployment, we do. The CMI numbers. And what the CMI numbers are showing is that the unemployment rate today is virtually gone back to where we were before the shock. Now, I think that hides more than it reveals, because as I think Mahesh has tried to point out, the quality of the employment is not the same. And there's been a loss of jobs actually among the white collar, maybe was it Pranjul or somebody did bring it up today. So the unemployment rate overall actually is no worse today than it was before the pandemic struck. It had become very bad during April, May, and then it quickly climbed back. But I think quality of jobs that is making up the additional employment is quite different from what we had before. I mean, a lot of it may be even relief, Manrega type of work and so on. So there have been very substantial changes in the labor market, I think, for the worse, but the unemployment numbers are not catching that. I think I'll leave it at that.
Okay, we are about 5 minutes over our time, but I can't resist this last question, which I think is quite important from Arvind Sainath, essentially saying that the RBI MPC doesn't have employment generation as a target, unlike the Fed, for example. And so they don't really track this part, and particularly the informal sector part, on which in any case we don't have that much data. And the question is, should we think inflation targeting is difficult enough without having to worry about employment? But should we be actually, given the nature of our economy and given that so many people still are in the informal sector, should we be formalizing in some way and moving towards a inflation targeting idea closer to what the Fed does? Any of you wanting to comment on, and we'll end with that question. Pranjul, you're closest to the financial markets. Maybe you and then Ashima, and then we'll end with that. Pranjul?
I'll take this opportunity to say something I was wanting to say even in my comments, but didn't end up saying it, is that I think at the to really come out as a winner from this pandemic episode, I think we really have to understand the informal sector. In fact, my own sense is one of the reasons why the pandemic has spread so much in India is because we misread the reaction function of informal workers. We thought that, if we call a 5-week lockdown, they'll just sit inside their house quietly. We didn't realize that many of them are daily wage earners, and they rushed home where their real social networks are as soon as they got an opportunity, and they took the pandemic with them. They carried the virus with them. And I think this is, even in inflation, it's going to be how quickly the informal firms, informal workers come back. That will give us a sense of, that will really determine where food inflation and core inflation go. So I'm completely, I completely understand the essence of this question, that, how do we really understand the informal sector? My sense is we just have to basically invest in our data. We have to be able to have a better way of understanding how the informal sector is reacting. A lot of the times we just collect formal sector data and we assume the informal sector reaction is the same.
Ashima?
Yeah, I think that inflation targeting is misunderstood, especially flexible inflation targeting. It's just a way of focusing on that inflation figure in communication to help anchor expectations. But there's a whole underlying model that generates that inflation. And in India, unemployment data was very diverse and not so reliable. So growth was used rather than unemployment. But I'm sure the MPC does look at, as more data gets available, and they are concerned about growth, that means they're concerned about unemployment. And they are churning all these things and then seeing, the inflation target. So inflation targeting is not flexible. Inflation targeting is compatible with the focus on growth and employment. And as our data improves, we will look at it more carefully, I'm sure. Yeah, and for the informal sector, I think that, again, the labor codes have something special for improving data and information on migrant labor. And so I think formalization is a good thing for the informal sector in the sense they can get credit. And a lot of it is now recorded. GST has a lot of data on informal firms. So it's not that it's a huge black box, that much of a black box as it was earlier.
Thanks, Ashima. I'm going to ask Sudipto for the last word, and then we'll close this out. And with gratitude to all of you, and of course, the very large number of panelists, a very large number of participants that we had in the webinar. Sudipto?
Well, I just want to thank everybody for having attended this, and it's been a very interesting discussion, more interactive, I think, than we've had in the past.
It's just the gender balance.
Well, that was, of course, quite deliberate, as you know, Shekhar. We wanted to have a decent record there, and I'm in a way glad. We're also in a depressing situation. I'm glad that Ashima has tried to, talk up our mood a little bit. I just hope that she's right. I'm not sure that she is, but I hope she is. And that's it. Let me end on that.
Okay, thank you, Sudipto. So with that, let me thank our guests, Dr. Ashima Goel, Pranjal Bhandari. Very grateful to you for your very perceptive comments and insights. And I also want to thank the very large QRE team, three of whom are here. Bhanu, who is, I saw him on the participants list. Thank you, Bhanu, for all your contributions. And to the very large team that backs up our colleagues at NCER and makes this possible. I hope that we will continue to issue perhaps even an update once the quarterly data come out or close to it. And as we did it the last time, we did one in May and then we did another one in June. So this is a continuing activity. It's ongoing. And of course, it results in the end on a mid-year review of the economy that will be available, I guess, in early December, which will allow us to take a look back at the first 6 months and see where we are. Again, thank you all participants for joining, and I wish you all a very good night. Thank you. Bye-bye.